Good afternoon, everyone. Thank you for joining us today. We hope you're doing well. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity. Today, we wanted to get together and talk about our outlook for the market, what's happening in the economy, and where do we see the markets head as we wrap the year. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Equity. Adrian is a director of multi-assets and he also is an expert on macroeconomics. Hi, Leah and Adrian. How are you all doing?
Well, thank you.
Thank you.
So let's start with the questions. My first question is about the markets and the economy. If you look at S&P 500 index, it is up 21% as of yesterday for the year, and this comes after a very sharp recovery last year as well. The economic data also continues to, surprise on the upside. What do you think is going to support the valuations going forward, and what can go wrong where we'll see some kind of slowdown?
Sure. Well, that's a great question, a great way to frame it up. The S&P is up really strongly. Meanwhile, the U.S. Treasury is at somewhere around 1.65% today, which is up this year around 0.7%. The U.S. dollar is a little bit stronger on the year. Oil is up 70+%. I say, general terms because it may bounce 2 or 3% on the day these days. Copper is up strongly, and the U.S. is the leader of the pack in developed markets or emerging markets. So we're seeing our sector leadership there. There's always the question of what can go wrong. If we look at prior years, and I usually go through and categorize this of what can go wrong on the year. In prior years, we looked at the trade war. Remember that? That seems to be gone these days. U.S. recession risk. Well, we've been there, done that at this point for the near term. Brexit and Italy. All those are things that are you read books about, but they're not happening right now. The biggest concerns that we're having now for the coming year, for the end of the year, and for 2022 are the fiscal impulse level and monetary policy. Both individually, are we going to get a fiscal bill via reconciliation or some other method? Monetary policy, are they going to lift off rates for the year? And how closely will those be coordinated to support the economy? We'll have midterm elections. That'll be intertwined with talk around corporate tax rates and individual tax rates going up. There's an outcome that is positive versus not positive there. And I think that the main outcome there is the next leg, the next foot to drop, whatever it is, of tax rates. Slowing growth in China. It is slowing over past years where we've seen extraordinary growth. It's not the worst thing if they do a soft landing as they drag a middle class in. So we'll be monitoring that. COVID variants is something that can go wrong. If we, certainly if we see a COVID variant that is more resilient to any vaccine that we have now, that would be a negative market dynamic to say the least. And we have these supply chain troubles in the economy right now. The LA ports are absolutely full. That means we're going to see inflation. Whether that inflation comes with growth or not is going to be a big question. So that's some of the things we're watchful for. There's always geopolitical risk. I think the geopolitical risk is a persistent risk premium, and we could talk about China and Taiwan and Russia and Iran. It's too hard to really navigate that as an individual investor. I think generally it's a risk premium in the environment that we continue to watch. But as far as pricing that into the markets, it's persistent throughout time. The things that can go right, I mean, it comes back to those that are the catalyst on the downside. A divided government is a positive usually. That likely means it's that we've gotten through the fiscal phase, but we are more or less likely to get tax hikes through. For the market dynamic, that will be a positive. Continued reopening will monitor consumption and consumer sentiment to see that we still see rising sentiment, that we see dropping unemployment rates. That's one of the biggest prognostication factors for the markets. And something we haven't really seen much yet is a reallocation of equities into bonds. Bond rates remain really low. There's a lot of cash on the sidelines. And if we see more of a reopening, if we see a hunt for yield, as we saw for the decade prior to the COVID crisis, then we could see rates lift off. We could see equities move. And certain equities will benefit and some will benefit less as we see rates go up. But that would be a positive catalyst for investors like ourselves that have the ability to look at individual sectors, names, asset classes for who will be the beneficiary.
Yeah, I think those are all really good points. There are really three things that I think about that weigh on me the most from a risk perspective. One is sticky wage inflation. I do think that's a potential risk. I'm hopeful as we continue to have more distance between the higher unemployment benefits rolling off, which just happened last month, that we'll continue to see a little bit of a moderation. But I think that's a true risk to the economy. I also worry about taxes, which Adrienne kind of touched base on. I do think the worst case scenario is getting discounted the longer the discussions have gone on, and you've even seen the bill, the discussions around the bill moving from the $3 trillion range down to just under $3 trillion. So I think there's less risk in that area, but that certainly does present risk. And then the last that I do worry about is China, as Adrienne mentioned. If you think about the rise in global debt over since the financial crisis, 2/3 of the increase in debt globally has been derived from China. And so you do have a government or an economy that is more and more dependent on stimulus. And they're the second largest consumers in the world. And so I don't think that's an imminent risk, but I do think it's a risk that we have to really monitor. On the flip side, what can go right? I do get really excited about the opportunities around innovation coming out of this crisis. And so if we go back and look at previous crises, I know I've mentioned kind of that 2008 downturn. The unintended consequences and the innovation that you saw come out of that is really the invention of shared services and shared services taking off. And those are companies like Uber and Airbnb. And they're great opportunities for investment, but they're also they're deflationary forces as well, which are really important. And even if you look at a pandemic, and obviously this would be more concentrated on Asia, if you look at the SARS crisis, which happened in 2002 to 2004, that really was the catalyst for the rise in Alibaba. And again, deflationary, but a company that really took off and brought a different technology to China and most of Asia. And I think it's going to be interesting to see what comes out of this. And I think it could be many things. I mean, just to kind of touch base on a few things. I mean, we have new technology around vaccines that we're seeing. We see ghost kitchens emerging. We see companies that are more innovative on reducing their expenses. The pull through in technology has been really just tremendous. Blockchain is something that is really early in its stage. I mean, people talk about crypto a lot, but really talking about how to leverage blockchain would be a truly deflationary force and something that could be applied to many other industries. So I'm really curious not only to see how things evolve, but I think those represent tremendous investment opportunities for clients.
Thank you. That makes a lot of sense. So let's talk about more short term. We are halfway through October. Where do you think the markets will be as we wrap up the year and the economy? Any surprises do you expect to see there?
Sure. And actually, just on Leah's comment, because it was so interesting what she talked about around innovation, it just strikes me that the longer this goes on, the more entrenched that becomes. The longer this goes on, the more technological innovation, the more pharmaceutical innovation on mRNA vaccines gets pushed to the forefront. Those companies are, go from liftoff to creating cash flows, and we adopt those technologies. Had this been a super rapid, it was just an Ebola crisis that was, you're less concerned, but then you reemerge in a week or 6 weeks or whatever it may be. Those don't get adoption. But what Leah is saying is really important for the future of investors' portfolios. The longer this goes on, the more you think that we might have this be something that is reasonably consistent. Whether it's even with a reopening, then the more you want to have some of this technological innovation in your portfolio. Sorry, so I'll get to the question. That just was very interesting what she said. For the remainder of the year, we do have catalysts that are the remainder of the year. The debt ceiling didn't just go away; it got pushed until a latter part of the year. If you ask me, I always think that's just it's an annual political football. We've raised the debt ceiling 78 sometimes. And more recent years or decades, it's become the political football for various political dynamics. And so I'm not too worried about that. I think that gets raised, and it's going to have an impact on what policies will get enacted or not. And of course, we have the fiscal stimulus, as Leah said. That's something that we'll be talking more about, how much actually gets printed and where does that money go into. I tend to think, we talked about a really large fiscal stimulus with a really large input into green energy, clean energy sources. I think that gets watered down significantly into more traditional priorities. Not all traditional priorities, but maybe some more traditional priorities, which for Leah and I has impacts on where we might invest in individual names or sectors for the remainder of the year. But I think you focus on the reopening effects of the economy, not the short-term volatility. And the reopening effects of the economy, the fact that we still do have coordinated fiscal and monetary policy, meaning if we get less fiscal stimulus, then monetary policy may step into the void and be supportive, is what keeps investors, and they should stay focused on remaining invested in equity markets and looking for opportunities in the sector or the name selection, because the S&P 500 absolute rate is not as important as the PE ratio. If we see corporate earnings continue to rise, as we have seen during just a very nascent start of this earnings cycle, that can support at a minimum just a static PE ratio, which means rising S&P 500 levels, which means a better prospect for investors' portfolios that remain invested. I've felt this year that we would see more of an emerging markets performance. We have not seen that this year. We've seen an underperformance, if anything, of emerging markets. It makes my palms sweat when I say it, but we're going to get there. And fiscal stimulus and reopening, and just recently Latin America tipped above 50%, and now more like 55% vaccinated rates. They've been slow to that table. The more they come to a reopening, the more we solve some of the supply chain issues that will be beneficial for them as we talk about a seek for yield. That's very positive for movement of equity into those markets. So at some point, we're going to see a very strong performance from those markets if we see positive growth in the developed markets. I'm more careful on allocation. We've seen yields rise recently in government bonds, and I think that's justified. I think that dynamic could go further. So we're positioned for yields to continue to rise, both in how we're positioned in our equity portfolio as well as how we're positioned in our interest rate portfolio. There are good opportunities in corporate bonds where we offset that with good income from lending, but risk-free rates are likely to rise out to the end of the year.
Yeah, I agree. I'm positive about what the overall, I would say what equities look like between now and year end. It might not necessarily come from the perspective of the big indices coming up. I do think correlation between securities is relatively low. And if you still look at the market, it's relatively concentrated. You have the 5 big tech stocks comprising 25% of the S&P 500, just as an example. But if you look beyond that, any headline that you see, whether that's the supply chain challenges, any issues that are occurring, there's a winner and loser there. And so that's where I think you've got these great opportunities, and equities as a whole will continue to do well, or you can pick areas that will continue to do well. And I kind of see we still have a nice tailwind as far as the macros are concerned. The other point I would mention is you did see a big rally last week when you did have the discussions around the stimulus bill coming down in price. And so I think the market had kind of priced in, I wouldn't say worst case scenario, but a scenario that is likely not going to play out, that the scenario will probably be more favorable than what the market has priced in. So I do think it's a really nice environment where you can do well in equities between now and year end.
Thank you. So super helpful. And just to build on it, you talked about innovation, the rising yield curve. So which asset classes or sectors do you all like the most and think that have the most upside?
Good question. Kind of drilling down into the asset classes, there's opportunity for investors to differentiate between those. Certainly, And we talk about the rising yield curve, not only the rising parallel yield curve, meaning across the entirety, but the difference between the 10-year rate and the 2-year rate will help value-oriented companies, those with shorter-term cash flows, think financial and energy companies, perform. Once again, my palms are sweating because energy is up 50+% across the companies on the year. That's a banner year, but coming from a low basis. They've been the downtrodden of the last several years because of very low energy prices. And so, with even just sustained, not rising energy prices, we could see companies continue to at least be cash flow generative and do well, which means rising equity prices. So that's a value orientation generally. That said, Leah's comment I really like around investors wanting to have exposure to some of the thematics of the future, especially as this is a more consistent, if you call it that, crisis that we're going through. The persistence means some of these adoptions will be stronger. So thinking about the thematics in the portfolio is sometimes as important as your individual name selection. So looking at the technological change of the crowd sharing or the Uber kind of adoption. So thinking about electric vehicles, thinking about AI, thinking about energy storage, looking at the mRNA vaccine that has been a Moderna and a Pfizer and help. Those can help solve other things that research has gone to the forefront of: HIV, cancer, blood diseases. So there's a strong potential for some of these thematics to grow significantly. Investors should make sure that they have exposure to some of these things for the adoption. So I think that's very important to look at, just as important as sometimes the sectors. So financials and energy, we're still strong on. Financials can do well in an environment where if volatility drops, equity markets do well, then we'll see leverage maybe pick up a little bit, and M&A from companies pick up. That's advisory income for many of these companies. So we're looking for potential there as well.
I think financials are really interesting. They've underperformed, and as Adrian's mentioned, as the yield curve steepens, which should be the case as the economy continues to recover, there should be nice opportunities to get some outperformance in the financials, and you've definitely seen them perform better. The other area that I think is interesting is really thinking about small caps and how they can perform. So I mentioned China as one of those risks that is out there. Small caps tend to be more domestic. And I do think if you look at what's happened over the last 18 months, the areas that have been the most impacted and have had the most pressure are the ones that have really had to rethink their business model. They've become more profitable. They've just ripped out their expenses. They've really had to change the way they've operated in order to survive this period. And I think they have the chance to really blossom. So if you think of who's in that space, small caps would certainly be in there. And as Adrian mentioned, like energy really went under a tremendous amount of pressure, and they've really had to rethink their business models as well. And then certainly they've benefited from some of the issues, some of the supply chain problems that are happening, which we can certainly touch base on later. But financials, some of the consumer sector, some of those companies, again, that really had to shutter, and such as restaurants, and make it through this period. I think they're just emerging as different companies. So I think all those areas present opportunities for us.
Super interesting. So let's move on from the individual sectors and talk more about the economy. So the next question is something that I think is on top of our clients' minds this year, and that is inflation. There has been a lot of discussion about whether it's a transitory inflation or a structural inflation, but the question is, what are the risks associated with inflation, and how does one protect their assets and investments from it?
Sure. I mean, the inflation question it started off transitory or structural, and just to think about how we frame that, the central banks have told us that they're going to let the economy run hot. They keep rates inordinately low, and they keep the fiscal response strong on the Treasury side. So that means that they're going to let inflation run above the 2% target in the United States. And in some sense, if the central bank says that inflation is transitory, then they can make it transitory. They can pull that punch bowl at some point, and they can potentially drop inflation unless it gets away from them. we are seeing inflation that is going up significantly. Certain baskets of goods that I don't think are well measured by what the Fed's core measure of PCE of consumption is, are going up dramatically in double-digit levels, and so that is concerning. And you know, all you have to do is look at the price of any house, or for a while it was even in used cars, to see that inflation is real. Where this impacts investors is, you know, bonds can be impacted by inflation. So this is risk-free rates we talked about a little bit, that can be, you know, that the erosion power on bonds is strong. So, you know, real interest rates, which is your interest rate less your inflation level, is still running significantly negative. A 10-year real interest rate. So if you buy a government bond, your real return expected is -1%. That's not very attractive, which is one reason that, you know, Leah and I are talking about potential pushes into equities instead. So you see some of those. I mean, and as we talk about the sectors, one thing we look at are the companies that are more attractive, maybe are those that have or less labor intensive, or have a capital structure that is less impacted by goods cost inflation and have more pricing power. And by all indications from the surveys I see, and from what I see coming out of companies, we've got this early earnings cycle and we've been monitoring statements on this. Pricing power is really strong for companies that are able to change the prices on their goods to reflect the inflation they see on input costs. That can be attractive. They can keep their margins stable. Margins are high as long as demand is reasonable and wage inflation is good. So you're still in that virtuous cycle of, I feel good, I can purchase things. Those companies can do well. Some protection areas, that's a good question. Of, I do think even with inflation where it is, it's good for investors to want inflation protection on their portfolio and to think about how to have that on. Inflation protection is still reasonably cheap compared to the yesteryears of some of the heightened inflation areas we've seen. Commodities and energy are generally inflation protection areas, even if we see demand destruction at some point. I don't think that's the case, but some of these areas can appreciate and provide a buffer for your portfolio, just as Treasury inflation protected securities can at points as well. It's harder for me to buy Treasury inflation protected securities, which are bonds that provide extra compensation for inflation, because you're buying at a negative yield. Instead, I would rather hold income producing commodity oriented or material sector oriented securities for some inflation protection. Now, granted, these are cyclical, so if we see a demand cycle drop, some of these could experience a drop as well. But I think it's good to have that protection on investors' portfolios.
Yeah, I think we always, when we're thinking about managing portfolios, we always have to think about what are the risks that are out there, and how do you hedge for those? How do you have a really good risk management process around your portfolio management? And I definitely agree with Adrian's comments. I mean, if you think about assets that will do well during an inflationary period, certainly real estate, financials could perform well. Again, going back to smaller companies tend to be able to pass through increases in prices more rapidly than a larger company. Those are definitely conversations that we're having, and as we try to properly position the portfolios. And we're definitely in a period where there's rising prices, without question. I think the bigger question to me is what does it look like when we get through some of these supply side issues? And are these here to stay? Are higher prices here to stay? Or what will things look like, let's say 9 to 12 months down the road? And that's where I kind of keep going back to the innovation and just the massive pull through of technology that's happened. I don't think it's, in my opinion, I don't think supports necessarily an inflationary type of environment. I was reading a McKinsey study that said some industries now up to 80% of interactions with customers are done digitally now. So it's just amazing how we are using either robotics or technology, and I think we're still early on really replacing people, sadly, and in some of the higher variable costs. And there is going to be a long-term cost to these things that are happening, and ramifications that we've got to think about. Also, certainly the work from home environment, you are going to get some trade downs. People don't buy as nice of clothes as they used to. corporate travel is going to be changed forever moving forward. People are less likely to hop on a plane and fly across the country for a one-day meeting now. Zoom is very acceptable, as is Teams. So I think you're seeing more of these video calls, and I think that's here to stay. So I think one of the most interesting things that we're going through is we've gone through a period which we haven't gone through in modern history of shutting down the global economy and restarting it, feeling what those ramifications are near term, and then trying to figure out what do things look like longer term. And the world will be very different. And I don't think inflation is going to be a big problem further down the road, but I could be wrong, and you always have to hedge for that.
Thank you. And my last question is related to it, and it's about oil prices. Adrian mentioned earlier that the oil prices are up about 70% year to date, and most of the energy companies are up around 50%. So what is driving this high oil prices? Is it just demand driven, or is there something more going on? And what kind of an impact will it have on the economy?
Sure. What's actually happening is, in our best estimation, it's part ESG issues where many of these companies have pushed to go through less discovery, less drilling. And because of that, we have less supply coming. So we have less of a supply dynamic. Of course, we have labor shortages in certain areas as well. So this has been less people at the oil fields, less people extracting. And then there's been some of the supply chain issues we have seen as well. So less ability to get some of this across and into the pipeline. All of those things I think have been impacting the actual oil price, keeping it elevated. Of course, OPEC or OPEC Plus, if you include some of the others, are remaining stable on supply, which has been keeping it at an elevated level. I think that can continue for a while. And as I say, the energy prices, like energy company prices, aren't predicated on a continually rising price of oil. They're more predicated on keeping oil at a stable cash generative level, at a profit producing level. So that's the important part. Now oil prices going up, and all of a sudden me paying $3.69 at the pump per gallon of gas versus $2, or whatever the prevailing price was before, may have an impact on sectors of the economy that are driving back to work. And those that are that's a larger portion of their budget. And that is always a concern, is there is a little bit of drag from higher oil prices on margins and on the consumer. Now, this circular cycle comes back to wage inflation. If we have pricing power and we have wage inflation, consumers can't afford this right now. As Leah pointed to as well, we're seeing some wage inflation, and wage inflation is outstripping the Fed's measure of core PCE of consumption level inflation. So from that perspective, it's sustainable, and we're not at $100 a barrel. We're not at extraordinary prices, but we are more elevated than we were last year.
And I think what's happening from a supply chain perspective is interesting across industries. And if you think about energy, I think it's also further highlighted a lot of the vulnerabilities. So if you think about Europe, for example, it's really made them more sensitive to the fact, from a natural gas perspective, they're so dependent on Russia. And I think, again, kind of going back to unintended consequences, I think it's interesting because I think it could adapt alternative energy a lot faster than normally would. You've had pressure around alternative energy from an ESG perspective for a while, but I think this could serve as a catalyst for additional spending around infrastructure. So again, I'm kind of curious to see how this plays out a year from now. But all this, I think any of these disruptions are really creating opportunities in another area, and it's fun to look for those.
Thank you. Thank you so much, Leah and Adrian, for your insights. It was super interesting to hear about all of them. Thank you, everybody, for joining us. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Bye-bye.
Thank you.
Thank you.